In August 2026, over 12,000 fans packed the Anaheim Convention Center for the D23 fan event. The atmosphere was electric, a massive physical demonstration of a cultural footprint that spans generations and continents. At the center of it all was Josh D'Amaro, officially stepping onto the stage as CEO. Greeted like a rock star by the Disney faithful, he is now the face of a massive corporate transition, tasked with leading the company through a highly scrutinized era. But step outside the convention hall and look at Wall Street, and you find a completely different reality. Despite the cultural momentum, Disney shares have been trading at a steep historical discount, hovering near $107, with a market cap of roughly $184 billion. This chart compares Disney's current valuation multiple against its historical norm. Right now, the stock trades at a trailing price-to-earnings ratio of about 22. Compare that to its 5-year median of nearly 52, and the scale of the Disney discount becomes obvious. This creates a strange paradox for investors. Analysts are overwhelmingly bullish, holding a strong buy consensus, and projecting a 12-month price target that offers nearly 20% upside. Yet the stock price remains suppressed. This valuation gap is the market's way of weighing a company with two conflicting identities. One part is a high-growth engine of the future, while the other is a legacy anchor that is slowly losing its pull. The first component of that growth engine is streaming. For years, the heavy costs of building a direct-to-consumer platform acted as a massive weight on the stock. But in Q3, Disney's entertainment operating income surged 64%. The primary driver was its subscription video-on-demand service, which reached a 13% operating margin. After years of burning cash to acquire subscribers, Disney Plus is finally generating profit. This chart tracks Disney's streaming operating margins over time. You can see exactly when the business model shifted out of negative territory. Management is now on track to maintain these double-digit margins for the full 2026 fiscal year, effectively ending the era of streaming losses. The second half of the engine is the experiences segment, the theme parks and cruise lines that serve as the company's primary source of cash. In Q3 alone, experiences brought in a record $10 billion in revenue, driven by a 3% bump in domestic attendance and a 4% rise in how much each of those guests actually spent while inside the parks. The profits generated here fund the next wave of the content cycle. With huge theatrical releases slated through 2029, including highly anticipated sequels like Incredibles 3 and Coco 2, the studio is leaning heavily on proven intellectual property. It's a self-sustaining loop. The hit movies drive demand for the parks, and Disney is committing a massive $60 billion over the next decade to expand those physical experiences, ensuring the flywheel keeps spinning. But then there is the anchor. These are the legacy and international divisions that are dragging down overall profitability and keeping Wall Street on edge. The heaviest weight is traditional sports broadcasting. ESPN saw its operating income drop 17% to $858 million in Q3. The math here is punishing. Programming costs continue to rise while consumers cut their cable cords in record numbers. There are also localized cracks showing in the otherwise stellar parks division. Management noted a distinct slowdown in consumer spending across their Asian markets, specifically hitting Q3 performance and spilling over into Q4. Properties in Shanghai and Hong Kong are dealing with a weaker consumer, proving even a global cash cow is vulnerable to regional economic headwinds. A volatile new risk to the legacy business is now emerging from a legal battle over ABC broadcast licenses. In August, Disney and ABC filed a major lawsuit against the Federal Communications Commission regarding early license renewals for 8 stations. Disney's legal team described the situation as an existential threat. The lawsuit explicitly claims the early renewals are part of a retaliatory campaign by the Trump administration, aimed at terminating broadcast licenses in response to unfavorable news coverage. This is why the valuation remains compressed. The streaming platform and domestic parks are generating massive cash, but Wall Street is actively struggling to price in the structural decay of cable and high-stakes political battles over broadcast rights. To navigate out of this, CEO Josh D'Amaro is implementing a strategy built on 3 pillars: focusing on the world's best storytelling, maximizing the intersection of technology and media, and operating as a unified One Disney. You can see that tech media intersection in action with their recent TikTok partnership. It's a first-of-its-kind deal that grants independent creators access to Disney IP to make short-form content, effectively turning the fan base into an active marketing arm. Leadership has committed to a massive $9 billion share repurchase program for 2026. This aggressive buyback is fueled in part by offloading non-core assets, like the $1.2 billion sale of their 50% stake in A+E Global Media. When management buys back stock at this volume, it sends a clear message to the market. They believe the shares are undervalued. And over the past 12 months, corporate insiders have backed that up with their own wallets, remaining net buyers of the stock. Looking ahead, the company's financial guidance points to an adjusted EPS growth of 12 to 16% for fiscal 2026. The financials suggest the internal balance of the company is finally tilting. The gains from the growth engine, specifically streaming and the domestic parks, are starting to outpace the decline of the legacy assets. With Wall Street projecting nearly 20% upside, the question remains, are the future profits enough to outweigh the weight of the past?